What's up, gold miners? Today we welcome DJ Van Keuren to the program. DJ is the founder of the Family Office Real Estate Institute, the go-to source for education on real estate investing within family offices. DJ also runs Evergreen Property Partners, a real estate investment group serving family offices. And over his decades-long career, DJ has overseen over $6 billion in family office investments. And in this episode, DJ gives an absolute masterclass on the psychology and the semantics of how the ultra-wealthy think and invest. We kick off the episode with DJ diving deep into the guiding principles of wealth creation and wealth preservation that he has learned and adapted from the ultra high net worth families that he's worked with in the past. Later on in the episode, we spend a lot of time discussing alternative investments, alternative investing strategies of the ultra wealthy, and why alternatives, even though they have been gaining popularity in the mainstream over the last couple of years, have been hidden from the public eye for so long. And then finally, to conclude the episode, DJ really shows off his intricate knowledge of real estate market cycles and presents his forecast to us in detail for 2025, 2026, and beyond. His predictions might shock you. I had an absolute blast with DJ, and no matter where you're at in your investing journey, there is a ton of knowledge that he drops that you can learn from. This is a guy that interfaces with ultra high net worth individuals on a daily basis, talks to billionaires all the time, and he truly understands the psychology, the systems, and the processes of wealth preservation and wealth creation. So you really owe it to yourself to give this one a listen. So without further ado, everyone, let's welcome to the show, DJ Van Keuren.
The Gold Mine Podcast.
DJ, welcome to the Gold Mine.
Thanks, Danny, for having me. I appreciate it.
I'm excited to chat with you, man. I think that you have a very unique perspective, handling more, institutional level capital, right? And this is something that it might seem daunting, might seem scary to some people from the outset. Oh, he manages, or he works at family offices. But I think there are certain principles that any retail investor, any investor can really learn from, higher caliber, high net worth, ultra high net worth families. And so, just to kickstart us off, because I want to, give the audience some instant juice here. Like, what are the three, guiding principles, like the three most important guiding principles in your opinion, that shape the trajectory of an ultra high net worth family's, like investment, trajectory, right?
I'm going to tell you. You want three, right? I'm going to tell you what I was told by every family that I worked directly for.
Yep.
Don't lose money. Don't lose money. Don't lose money. But, and one thing you were talking about institution, that's one of the big misnomers, that is in the market, right? Because people consider families to be institutional. However, the reality is they're more like the general retail client, the regular client. They are. And the reason why is because on the institutional side, usually you have people that are coming out of grad school or they're younger and they're investing on behalf of the pension plans, right? Or maybe the insurance company. It's not their money, right? Here, just like the retail, and the family office, you're just adding your zeros to. That's more like, that's your money. And you're never going to have that opportunity to create that kind of wealth ever again. I mean, some will, handful, but that's the vast minority.
Yeah. When you strike gold, you got to figure out how can we continue to preserve and preserve this wealth is actually what it sounds like to me, right? We're less concerned with multiplying it and more concerned with how do we not lose this? Because that is the one thing, right? And I've read many testimonials, things online where, and you talk about it yourself, the 70-90 principle, right? So after the third generation, it's like 90% of it's gone or something.
Yeah. 70 by the second gen, 90% by the third gen. And, there's a couple good examples of that actually. Well, one, everybody knows about the Vanderbilts, or of the name anyway.
Mm-hmm. Of course.
And in 1878, Cornelius Vanderbilt was the richest man in the world. When he died, he gave the majority of his money to his son. And 5 years later, his son doubled that money, right? So that's right before the 1900s. You fast forward to 1971 when they had their first family gathering at Vanderbilt University. There was not one millionaire there. And,
wow.
You know, one even closer example for me anyway, as I was in my office a couple years back, somebody comes in and I said, "How you doing?" He goes, "Not good." I said, "Why?" He goes, "I just lost 80% of my family's money." And I said, 80%? Well, about an hour later, I had to ask, "How much was that?" And he said, $800 million. So it happens. It's real.
Yeah. The question is why though, right? Because what are the reasons why, and how can investors kind of like learn from others' mistakes?
There's a number of things. One is not involving the younger gen or the next gen, right? So you could have a patriarch or matriarch who's just always been in control. It's hard for them to give up control, right?
Right.
So that's one of the reasons. Education or lack of education, should what we say. Lack of organization. You know, it amazes me that somebody builds this large business that has quarterly reporting, right? And they have meetings all the time and they have policies, but yet their family office doesn't have any of that stuff, right?
Yeah.
And that is, and you wonder, well, this is what got you successful. Why are you doing that now? And then at the further you go down the line, the further away the next gens are from making the money. They didn't make the money. So they didn't, they don't know how they made the money, right? And that's important regardless of how much money you have. If you do have money, you do need to prepare, or you should prepare the next gen to understand how to be a good steward of that wealth.
Yeah. And I mean, that makes perfect sense to me, right? Because ultimately creating wealth is all about certain principles, right? Like there are principles, there are processes, there are systems, maybe a little bit of luck too, right? That's always a part of it. Right time, right place. To be able to skill transfer though, right? I think that seems to be the part that lacks. And actually, do you know Alex Hormozi? Have you heard of him?
No.
That is. So he's a big private equity guy, sold a business and made a lot of money. And now he's one of these online gurus, but very savvy business mind. He says, "I'm not going to leave my family with anything except like a educational library full of like videos on how to recreate the wealth that, you know what I mean? Like, so he understands. And when I read, or when I listened to that video, I said, and that makes a lot of sense, right? Because it's really not about the money. It's about the wisdom, that created that money. Right. That's ultimately like the most valuable.
I mean, it's very, you know, a funny story. I mean, you grow up differently if you have that much amount of wealth, right? In fact, I heard a story once where the family got on board a commercial jet and the kids were young, probably 6 or 8 or whatnot. And, you know, they hadn't been doing very well. And the kids looked at mom and said, "Why is everybody on our jet?" Yeah, because that's how they grew up. What was in that, and it's you know, it happens a lot, obviously. That's not being transferred properly at all.
So herein lies the dilemma, right? How does a family office then create systems and processes to preserve wealth? Right. So if we're not going to be able to trust the family to grow it, in fact, by giving them money to grow it, we might actually be shooting ourselves in the foot. They're going to lose it all for us. So instead, let's implement some systems, processes to go about and preserve that money. So what do the actual semantics of that look like on the back end? Like, is there a specific portfolio breakdown that you're seeing that has worked? Is it not a one size fits all approach? Like what are you seeing kind of behind the curtain?
Well, there's two things, and there's what I call the hard side and the soft side of a family office. And the hard side is the investment side, which everybody thinks about all the time. But the soft side is making sure that how are you going to transfer that money to the next gen? How are you going to involve them? is the legal, everything legally property put together? Do they have the proper trusts in place? Sometimes they need counselors to help them through, because everybody has fights with their family in some degree at some point in time, right? Whether it's your aunt, your uncle, your father, your mother, your sibling, or whatnot. And then when you add all these extra zeros, it just increases the magnitude because everybody just wants to go for the money. And so it's a matter of, of making sure that you focus on that soft side, because really that's where those systems and processes are that you're bringing up. So a few of the key words that come with that is family governance. And that is, how is the family going to operate amongst all the siblings, right? And what does that look like? And, it requires you to get everybody on the same page, right? So that's one thing. Depending on the size of your family, you might have a family council. And those are the main family members that are making the decisions, because let's say you've got, 20 members of the family, which is extended, but 10 of them are under, 10 years old. They're not going to be there making decisions. But at some point in time, when they hit a certain age, you bring them in, right, to make decisions as a whole. And then you get into the investment policy statements. How are we going to allocate our money? But first, let's make sure that, we're all on the same page. Because if you think about, somebody investing in real estate today that's 50 years old, they might be like, or 60 years old. Let's just go into income producing properties, right? And let's make sure that it's stable and it's safe and all this other stuff. So triple net properties, right? Let's go into the 7-Elevens. Well, the younger gen, they're like, listen, we need to invest into real estate technology. We don't need that. We should put it in the other place, or let's go out and buy this decapitated building. The risk profiles are much different, right? And that's why you have to sort of look at it globally. And then the last thing is getting the rest of the family involved. One of my favorite patriarchs that I met did something that I'll never forget. And I think it was like their 10-year-old granddaughter. He gave her $1,000 and said, I want you to decide where you want to give this, right? So that it's a gift. It's a thing, that you're going to have to allocate. And she really got into it. She's like, who do I want to have this money? What's important to me? What is that? What impact is that going to have? I mean, she starts thinking about that. It's not how much money. It's just being part of that process.
That makes a lot of sense. So what I'm hearing then is that before we even get down to the strategy of it all, we need to make sure that the family is in alignment, right? That that we don't have any sort of intra-family issues that are going to, effectively cause. And that makes perfect sense to me, right? Because you said the hard side of the soft side, right? So the soft side, these are the emotions. So whenever you're talking about all this stuff, I just keep thinking of that Succession, the show Succession. Have you seen that?
That's real. That's real. I mean, that shows you the dynamics. Yeah. And they did a really good job of, especially with the one child that they sort of pushed out of the way. I forgot his name, but and then you had the one that was running as an election. He put $100 million toward election. Well, he doesn't understand money, right? He never had to work in his life. And the patriarch was so driven. I mean, that is a real awesome show. But yet that's real.
Yeah. Yeah. No, I can totally believe that. I can totally believe that. So, well, why don't we take a step back right now, DJ, and kind of get into, what got you into, this space? Because you weren't always doing this, right? Like did I read this correct that you were a Vietnamese coffee entrepreneur? Is that actually?
Yeah. So in the 90s, I was a financial advisor. I sold that. And my best friend at the time was in Vietnam for a number of years. And I was going back and forth. And there was an opportunity to start a coffee brand. So I co-developed a coffee brand. Today, it's the largest coffee company, I believe, in the country.
Wow.
But it was an amazing experience. And it really taught me it got me back on track of being entrepreneurial, but also got me thinking bigger, because that's the people you met with, they're in charge of 4 countries, right? It's not just in charge of the city. So, which was great. And then I came back and I literally said, what do I want to do? And I said, I've always loved real estate. So I read every book there was for the next 12 months. And, I even read the Carlton Sheets stuff all the way down to, a class I had at Harvard. It's all the same. It really is the same. Whether it's a house or a building, it's the same. It comes down to, are you implementing properly? Right.
Yeah.
And so, I put together some private capital, started what was going to be the first single family REIT. And I was way ahead of the curve on that. Saw the downturn coming. And then, so I sold the portfolio, went back to grad school at Harvard, like I said. And then when I got out, I was working with a number of developers and institutions like Carlyle, Goldman, Blackstone. And then when I moved to Denver 10 years ago, I literally fell into the family office space. It was not planned. In fact, 95% of the people that work in the family office industry really fell into it if they work for a family. Because what happens is that somebody has a big exit, 200 million, 100 million, 500 million, $1 billion. And the first thing that comes to your mind is not, okay, who's the smartest person I can hire? You know what the question they ask instead? Can you guess?
How am I going to spend this money, or who am I going to, what am I going to buy first, sort of thing?
Who do I trust? Who do I trust to watch this money? Right.
Yeah.
And so, because it's never going to happen again. And so you have people, I made a big mistake when I started where I was like, oh, all these wealthy families, they're smart, they're intelligent. They obviously made a bunch of money, and I'm talking about high level real estate stuff. Well, the reality is that they might have spent the last 40 years in chemicals or tires, right? They don't understand private equity, venture capital, real estate, hedge funds. And, people spend their whole life, not just in private equity, but healthcare private equity, and then certain size companies. And so, and so there's that education gap for all those types of investments, but it's the same thing for the person that you hired because you trust them, right? They're going to do whatever they can to make sure that your money's safe, but they still don't have necessarily the correct knowledge to make a lot of those decisions or set up the family office, things like that.
Well, DJ, I think the same thing could be said about, retail investors, right? So you got a guy who's making $200,000, $300,000, $500,000 a year. And these are smart people, right? They're educated. They're clearly good at what they do. And yet they kind of fall into that same, like the greenness trap, right? Where they're good at what they do, but they don't understand alternative investments. And so they've been indoctrinated, right, by Wall Street, truthfully, so you're about to say something, so I'm going to shut up.
No, it's true. Now on the retail side, you have that there's a lot of advisors. Any profession, there's people that aren't that good, but that happens on the retail side, probably a little bit more because it's typically all commission based to some degree.
Yeah.
And so because they need to educate the retail clients if you're working with somebody, but if they're not educated, then they're not going to be able to educate, the next, their investor.
Right.
And so but it's the same thing. I mean, regardless of how much money they have, they may never ever see that ever again.
I actually have a story that I think you'd find very fascinating. So I was speaking with a gentleman who is a high-end home developer here in Silicon Valley. He, builds new construction, $5-ish million homes, right? Like $5 to $10 million luxury homes here in the Bay. And he also owns about 60 rentals in Phoenix. And so we were just chatting and I said, hey, just out of curiosity, have you ever thought about investing into like real estate syndications? You know what he says, DJ?
What?
What's that?
Wait, invest into what?
Real estate syndications. And he's like, what's that?
Oh my gosh.
Exactly. And so, I mean, this guy is a multi-millionaire, right? Has a very savvy real estate investor, right? And this guy had no idea what a real estate syndication was or a real estate fund. And so it was in that moment, DJ, where I was like, you talk about education, the education component. It's like, if this guy has all the advantages really in the world, right? Should have all of the advantages in the world to know that these sorts of opportunities exist, and yet he doesn't even know about them. So if he doesn't, how could we expect, all these other people who work in tech or working in chemicals for 40 years, right? Like you just said, how could we expect them to know about it? So I think there's something to be said about that.
There's no wrong questions in my mind, and because that's how you learn.
Yeah.
And so you do need to be able to say, I don't understand. In fact, somebody that's a patriarch that's worth well north of $1 billion has become a really good friend of mine. And I'll never forget last year, we were talking about something and he's like, DJ, I don't understand that. He goes, I know what I don't know. Can you explain that to me? And so he's very humble. And, of course, the way he's saying it, you're like, I want to help you, which is probably how we got to be that wealthy. But he was like, I don't know everything. I know I don't know everything. Can you help me? And so everybody should do that. But a lot of times people feel embarrassed or whatnot, which I totally get. But at the end of the day, it's your own money and you need to know.
For what does that process look like? So you're saying like, hey, there's a lot of greenness kind of coming in, even, from the family office side of things. So what is your process to kind of like educating these people and getting them, because education precedes comfort, right? So it's like you need to educate yourself to become comfortable enough to invest. So what does your process look like?
Well, I really, education has been a major component of mine because that's what you read, right? It's always about you need to provide value, educate, etc. And that can come in some different forms, but one is getting credibility and being somebody that people can trust, right? And that happens from, whether you speak at events, whether you're on podcasts like this, whether you do podcasts, whether you write articles, right? Because you can share those with potential investors too, that you're writing this or writing that. You can write a book, So I did write a book, which is a pretty fundamental book, which is good for everybody. It goes over everything from cap rates to income. It's a pretty small book. So I've written a book. I've also, I'll write. I'll speak as much as I can because I love to do that. And then I found the Family Office Real Estate Institute. So for me, it's a little bit more extensive because we created an executive education program that has professors from Harvard and Wharton, University of Chicago, and industry people. And we do that on campus at the University of Denver, but we also do it online. Now, the difference that our program is compared to some other programs about families is that we'll probably have 70% about real estate, learning fundamental real estate stuff. Yeah. But then we'll have a class on governance. We'll have a class on investment policy statements, right? That starts to get in there. Another thing is, put out white papers. And then there's an annual conference that we do. This is going to be our third year. And a lot of the conferences you go to, sponsors or the people that want to find investors pay money, right?
Yep.
And the majority of the time they put them up on stage. Well, to me, that's not going to benefit me because they start talking about their deal or something. So we have a no solicitation policy, and our topics are based upon what our board says. This is what we should talk about. And once again, we'll go over governance. We'll talk about some other family issues, transitioning the business from one gen to the next, right? The biggest thing that families love is hearing from other families and learning from other families. Yeah. How did you do this? Or, wow, you made those mistakes, or you did this right. Well, how did you do that? And so it's a lot of, families love being with families, because the reality is that they have issues that they have to deal with that you and I just have no clue. Yeah. I mean, oh man, my jet just had a problem. I got to make sure it gets fixed. You know what I mean? So
that darn jet.
I know, right? So education, and it's super important regardless of whatever level you're at. And the best person I've ever seen in the family office space for education is Richard Wilson. And he's a friend of mine. And I knew about him when he first had just a family office list. And today, I mean, he's interviewing billionaires on stage left and right, and they're coming to his events and everything. And what Richard did, and this is what I did where I got to where I was, is he did everything you're supposed to do that you don't do, right? Mm. You're supposed to write an article and submit it so that you can at least get your name out there. You're supposed to put a podcast on, or you should try to, provide a podcast as a resource, but you don't do it, right? Yep. And that's probably the big obstacle, especially when education too. You want to provide education, but are you actually sending emails to potential investors, in this case, families? And it doesn't have to be trying to raise money. It can be something simple as, hey, I'm not sure if you know, but because of this new policy that the Trump administration passed, this is what's going to happen to real estate. Mm-hmm. They may never have seen that ever before. And all you do was just say, hey, just want to let you know, and you send a sentence or two. Yep. That's education, right?
Yeah. I love that. And I, would you agree with me though, that perhaps, and this is more true in the family office space, probably than say like the retail space. But like there's what I've observed at least is there are certain people, majority of the people out there who don't come from wealth are so intimidated by it that they would never even approach those people because they don't feel worthy, right, of approaching. But guys like me and you, it seems like we have no problem with that. Because we understand, and it sounds like you understand, I know I understand, that we have a deep understanding of these investment vehicles. And no matter how smart they are, right? No matter how intelligent, like they don't understand the fundamentals. They don't understand these investment classes as well as we do, right? So you are worthy because you have something to share, right? It's not like you're some.
Well, that comes with any time you have. That's what breeds confidence, is having the knowledge, right?
Right.
The only way you're going to get knowledge is to listen to podcasts, listen to books on tape, read books, watch videos.
100%. Absolutely. I want to switch gears here a little bit, DJ, because you touched on something earlier. And I was like, I want to get back to that. Talking about institutional capital and how it's actually different from family offices, because families are investing their own capital. And on the institutional side, you've got a lot of groups that, have fresh grads, right? And they're not even investing their own money. Why is that, right? Like, why do we have people that manage money at scale that have never made, like, you know what I'm saying? Like, this doesn't make any sense to me. Why there's a gap between the knowledge base that's required to achieve that wealth, and then the knowledge base that's required to just deploy that wealth on behalf of those who have actually already achieved.
Yeah, well, they do have that knowledge. They do have that sophistication. And in fact, if you take money from an institution, they're going to be all over you. I mean, they're going to know when you wake up, when you go to sleep, where you went. And they'll dive so deep into analysis. So they do have all that, but the issues they have, once again, it's not their own money, which is the variable here. And then the other thing is that you look at, the New York City Police Department, what do you think their pension's worth? It's probably absolutely astronomical.
Yeah.
And how are you going to invest that money? You got to get the money out.
Very
so
true.
I personally think that majority of institutions they're not good fiduciaries from the mere fact of, I got to get money out, because if I get money out, then, we make these X fees, management fees, or whatever the case is, or I get a bonus based on this or that. And it's not my money, so I'll just, I'll get it through. But the knowledge is that much greater. But, it's different when you make a decision to buy something yourself, or somebody gives you money to buy it, and you can see that a lot if you have kids or younger people, because you could be like, oh, I want to buy this, and okay, I'll give you the money. Well, then when you say, you use your money, all of a sudden they change. I don't really need that. Right.
That's interesting. It's an interesting perspective, and, I just keep thinking about, the investment bankers, they go fresh out of school, they're making big time decisions. Also, I do see some parallels between the financial, advisory industry and what we're talking about. It's just financial advisors are to retail what, institutional, or these large investment banks are to like institutional capital, which is like, I think Warren Buffett said that Wall Street's the only place where someone who rolls up to Wall Street in a Bentley will take advice from someone who came in on the subway.
That's pretty funny.
And it seems like the same parallels exist there on the institutional side of things as well. But it's not to dog on or to rag on the industry, right? But especially now, DJ, that there's this rise of alternatives, right? We're seeing this like rise of alternatives just in like the last 5 to 10 years, right? It's become a little bit more mainstream. You hear about it a little bit more. The ultra wealthy are starting to allocate more and more of their money to alternative investments, but yet your financial advisor will never tell you. And so what I find fascinating is that, like, legally, when I make a YouTube video, I need to say like, oh, make sure to consult with your financial advisor, but like your financial advisor will never tell you to invest in the alternatives.
Well, there's advisory firms that focus on alternatives, right?
RIAs, you mean?
Some RIAs. There's also, broker dealers and whatnot. The big wirehouses like the Morgan Stanleys of the world.
Correct.
They're usually providing products that are their own from within the company, right?
Yep.
But one of the things that you have to realize, and if I ever got to speak to the SEC or FINRA, which is the governing board,
right?
Here's the thing. So they want to protect the consumer, right? Which is understandable. However, so you have people that didn't need to have any education. They didn't have to pass the test. They didn't have to get any type of certificates or degrees or anything. They're commissioned only, and you're having them provide financial advice. Do you see a problem here? Because I'm commissioned only, and I can make a 5% commission or a 2% commission, and I need to put money on the table. What do you think I'm going to do? Even if that 2% commission is better for the client.
Exactly.
And so, I tell people, and I know this because I was in in that business. I'll ask people, they could have 100 million, 50 million, 200 million. I go, what business are you in? And they say, well, I'm in the advisory business. I'm like, no, you're not. You're in the marketing business because you need to gather as many assets as possible and get as many clients as you can until you hit about 750 million. Now you're managing, you're making those decisions because you don't have time to go out and find all these people.
Right.
And so that's really, and then it's a matter of who came in the office last that's promoting their product too. Mm-hmm. But the other issue too, why there's not a lot of these alternatives is because these broker dealers are liable if something goes wrong, because inevitably there will be lawsuits, and they have insurance, but there'll be up lawsuits to the point where today the majority of them need third-party reports that are doing the due diligence for them, because that person making those decisions on the investment products that can be sold, they probably don't have an understanding in private equity and real estate, right? You see the trend that's happening here? It just continues to be an issue, goes back to the education and knowledge. That's where if I was sitting on $200-300 million, what I would do, if I wanted to invest in a certain area, a category, I would find a family that created their wealth in that category and ask if I can invest with them, because they've proven success. They know what they're doing. Obviously, they have their own money in the deal. In fact, all of their wealth is created for this. You think they understand that? Inside and out. And I mean, they're not gonna, they've been successful doing just that, you know, but you can, with the retail investor, that's one question you always should ask is, how long have they been doing this? Whoever you're investing with, whatever product it is.
Yeah. And you touched on something there, with the wirehouses, right? Like they are liable. And so I think that's another reason why we don't really see like those types of financial advisors. And I don't want to loop everyone into the same category, right? But like, you think the majority of Americans, when they think financial advisors, DJ, they think wirehouses, right? They're thinking like the big players, right? Like when you hear like financial advisor, you're thinking Morgan Stanley, you're thinking Schwab, right? You're thinking all these like big box firms. And yeah, I mean, like you got guys that just passed their series, whatever, 765, whatever licenses you need to sell those securities. And then they're rolling in and they give them some training wheel portfolio strategies, because that's really all they're equipped to handle at that point. But if you're making a lot of money and you're just kind of blindly passing it off to them, which is what a lot of people are told to do.
Or you're not given any portfolio and you're standing still. Yeah. And so it's, who do you know? Start calling them, tell them that you changed your career. And that happens the majority of the time. You walk in with flat-footed. And so now here you are. I mean, I was 22 years old giving financial advice to people that were, 60, 65. Yeah. I mean, and I'm just regurgitating what I was told by my boss at the office. Yeah. Yeah. That's insane. And then it got to the point where I started really digging into understanding the investments. Right. And so then I was like, well, my manager says, well, you need to sell this or that. I'm like, no, I don't believe it. This is better. But that's and that took me time to get to that point as an advisor, a couple of years probably. Yeah. That makes a lot of sense, because you have to experience it, right? There's no amount of education there is kind of get you ready for the real world. So that's fascinating. So where is this all headed now, DJ? Like I actually had a gal, you're familiar with Preqin? Yes. So I had their global head of research on the show a couple months ago. And she was saying that the average ultra high net worth family currently has about 40% of their portfolio invested in alts. That's expected to increase to 50% by 2029, half the portfolio, and only 30% to stocks. So where do you see the future of this alternative investment movement? What categories stand out to you the most? I know you're a real estate guy, right? So I know that you love, and so am I, that you love real estate. So more real estate, or are we going to see other sectors start to grow as well? Well, there's an interesting thing that's taking place in the family office space. with the real families. And they're starting to take over some of the large firms, the private equity firms. They're making investments and have more money than they do, or they'll go to a couple families and say, let's all put in, $20 million or whatever the case is. And that's continuing to grow. So that's happening. And they're starting to form companies where they're bringing in other money as well. It's not just their own money. They're starting to create entities. And with real estate, the average allocation is about 24.5% for families, but it's good in the sense against stocks, right? And a lot of alternatives give you that, not just diversification, but also it increases the safety of the portfolio, right? Mm-hmm. And so I think it's going to continue to grow. We are going to go into a recession, 26, 27. And I've been saying that for 5-6 years. And when that happens, people start pulling back, right? And they're like, I'm worried about this or I'm worried about that. But they'll get back into it from that perspective. And the longer you see alternatives, the more comfortable you get. It's not just a flash in the pan, or it's not just something that just came up. Well, what is that? And so I do think it's going to increase. It makes sense to me.
Okay. So first question, why is there going to be a recession in 26 and 27?
Because you can go back 250 years in the US, the UK, and Australia, and real estate runs in 18.5-year cycles. Mm-hmm. And it's very consistent. And when you look at our last recession coming out in 2012, really, is when we started to come out of the recession.
Sure.
We're about to, we had the year of COVID. It was a black swan event. And that's why I say 26, 27 instead of just 26. But it's been consistent, and I can share, some of this data with you where it just happens. Yeah. And when you think about it, I'll give you one of the reasons why, and I'll use real estate as an example because I think it's easy to explain. When you come out of recession, nobody was building during the recession. They're not making new buildings, right? Mm-hmm. And banks don't want to lend because they're going to tighten everything up. And so nothing's being done. Well, then then things start to come out of the recession. People are getting, happier, and they feel better that they can spend their money. Banks start lending. People start developing, right? And now all of a sudden you're going up at this wave. Well, at some point in time, banks pull back on their lending if they get worried, and we overdevelop. If we overdevelop, what happens? It drives prices down. And then you get to the point where the demand's not there anymore. So why am I building? And guess what? The whole cycle just starts all over again. And we're humans, and we don't learn necessarily from our past mistakes. I can assure you that any multifamily investors or multifamily companies since 2012 has made money up until 2 or 3 years ago. Yep. Right. And there's reasons for that. But I can assure you they won't make this mistake 10 years from now. Right. Because they've learned from it. And the question I always ask on the real estate side is, I literally say, how many properties did you give back to the bank during the Great Recession? Mm-hmm. And if they did, because everybody did. And if they didn't, then you're like, wow. If they did, then my next question is, what did you learn from it? Mm-hmm. And so it's the experience that allows you, which is a part of education. It comes back to the education, right? Which is learning from the past.
Yeah. I think that's a really interesting perspective. And, it's funny because you and I were kind of interfacing before. The blood was supposed to be flowing like 2 years ago, right? And a lot of this was because of the loan maturities that were coming up in the commercial real estate sector. And for 2 years now, seemingly, we've been in this delay and pray part of the cycle. So you think all that starts to pop. Now, are we talking commercial and residential then, DJ? Is that what I'm hearing? You think residential's also going to take it? Because honestly, like in the Bay Area, residential's already taken a hit, man. We're seeing prices are coming down.
So the stock market will lead the real estate market when it comes to downturns. Mm-hmm. We've seen what's been going on with the market, right? It's been coming down.
Yeah.
And then you're going to have the commercial real estate and you know, the market's all based upon emotion. Mm-hmm. And so, and what you can buy because of the loans that are available. And there are $4 trillion of real estate loans coming due in the next 3 years. And I'm getting phone calls about deals that are starting to fall apart. Mm-hmm. And, that's going to continue. And then when that happens, people will start not wanting to invest in everything. But what you're saying with San Francisco and the prices going down, I think that's a big reflection of how the country feels about what's going on, right? I mean, tariffs. Walmart just came out today and said, we're going to start raising prices because of the tariffs, right? So, and that's, you know, but we're regardless of whether Trump did that or not, we're still going to go into a recession.
Yeah. I mean, look, I don't disagree with you. I think that the pain, like this has been a very delayed, you know, pain, like it's been drawn out. I feel like we've been going through this, like, you know, mini crisis now since like 2022, really. It's like when it really started, right? Mm-hmm. Was 22 and we're 2 years into it. And so you know, in 2008-09, like it came like a, you know, like a freight train. But this time's been different.
Well, yes. And the main reason for that is because you had, honestly, it was the mortgage industry that really drove it and greed at that level. Have you seen the Big Short?
Oh, of course. Great movie. Yep.
Great movie, right? My first patriarch I worked for, who's the smartest real estate guy I ever met, most analytical, he actually did research, wrote a white paper, went into New York City, talked with all the main companies, real estate companies, Jamie Dimon, and said, what am I missing here? And he said, everybody but one person said, nothing's going to happen. And, you know, as soon as you start hearing 100% mortgage and no, you know, no proof of income, that's just set to be, I mean, that just sets to be the problem.
Yeah.
And when there was one last thing I'll say about that is that I was looking at buying some multifamily properties during the recession. And so I started calling at that time apartment owners in Phoenix. And I'll never forget, I'm talking to these owners about the properties and trying to structure different deals and stuff. And consistently, they're behind on payments and everything. And I'm like, or they're having troubles. And I'm like, the banks don't know. I was like blown away. I'm like, they don't understand what's going on.
Yeah.
And, you know, that's happening now again in the multifamily space for sure.
Yeah, I think it's happening in all commercial real estate. I just saw the latest special servicing report. We're breaking records every month, and it's not in the right. It's not the good kind of record, you know. So it's interesting.
But this is where the real wealth is made.
Bingo. You beat me to it.
I mean, so look, when somebody loses, somebody wins.
Yeah.
And so it's a matter of being astute enough to be aware of that. And, you know, Warren Buffett would always say same thing. Buy when there's, you know, blood in the streets or whatever the case is. I forgot who said that. But this is we're about to embark on one of the greatest times in history to create wealth. Mm-hmm. And so people need to see, if you're sitting on the sidelines, start putting your cash together because there will be opportunities and significant opportunities.
Okay. So that leads me to my next question. It was a two-parter. You answered the why. Now it's how does one take advantage of what's to come? In your opinion, what are the things that investors should be out there looking for 2026, 2027? And how far into that pain cycle, that recession, do people actually start making moves?
Well, I think one is to don't listen to the news necessarily.
Yeah.
When there's a couple of things, like once you start hearing and you talk about alternative distress fund of sorts.
Sure.
There are companies that's what they're doing. They're going in to buy distress, right? So
Yep.
One is to look for professionals that are out there every day that can do it for you, right? And so that's one way. Another one was Peter Lynch was with Fidelity. And I read this book so long ago, but it's true is to, invest into things that you know. I mean, when I lived in Seattle, I went up to the campus for Microsoft, and on the news, they're saying how they're going to go under and they're doing so bad and everything. And I remember I was like, they're building like crazy on this campus. There is nothing wrong at all. I mean, they're in the growth mode, right? And we know where they are today.
Yeah.
And so I think it's just a matter of keeping your eyes open because, when stocks go down, if you're going to invest in the stocks, is it a good company? Do they have a good track? Do they have good management and stuff? Because they're going to come out on the other side.
Mm-hmm.
And don't sell. If you're already invested and your money is going down, don't sell because you haven't lost any money technically until you sell.
Right. Yeah.
And so hold on, be patient. I mean, that's probably one of the biggest things because I think more people lose money than make money during these times out of fear.
Yep. 100%. So you for example, let's say that someone is invested into something. And by the way, this is not financial advice. Disclaimer.
Yeah.
Let's say someone's invested into something that's, it's coming down. It's liquid, right? So liquid stock or something like that. And they see another opportunity that, where they believe it's going to be a lot better, where their money's going to be put to use a lot better. You would recommend selling him in at that point. You just let it ride.
Well, that's where you've got to come back to. Are you making a decision based upon emotions or fact? Right? Because I always say with real estate, and as you said, I mean, that's my focus. 90% of a real estate decision can be analytical, 0 emotion. The last 10% your gut, if it's a good property or whatnot.
Yeah.
And so if you're going to sell, before you sell, you go, let me understand really what's going on there in the company, and maybe that's listening to a video that they talked about or a podcast, something easy like that, because you can't understand the financial numbers. But I mean, that's where you need to, Amazon, oh my gosh, it's going down significantly. Come on, they're going to be around through the recession and probably prosper, right?
Exactly.
And so there's no reason, even though if it's down. So I think that if you figured out and you said that company is they're done. I'm going to get my money out and I'm going to make it back up over here. Then I would say you do it. But 98% of the time, you just need to hold on.
Yeah, that makes a lot of sense to me. It's like, hey, if you believe the long-term trajectory of this company is on the up and up, then the whole market's taking a dip right now. It's not because the company's necessarily doing poorly or any worse than anyone else is right now, so to speak, but more so just a reflection of the market conditions. DJ, we are way over time right now. But I've been enjoying this chat, and yeah, man, first of all, if people want to find you, they want to get connected with you, where can they find you? We'll make sure to link all of this in the description down below.
On my personal website is djvankeuren.com. That's probably easiest because you can see my name. If you want to learn about the real estate education, that's at FORE, stands for Family Office Real Estate .institute, not .com, but .institute. So .institute. And then there's evergreenpropertypartners.com. So those are the three biggest things. Or quite honestly, you could just put me in Google and something will come up and direct you in various places.
Yeah, you're all over the internet, man. Well, this has been an absolute masterclass. I hope this will not be the last time, DJ, that you're on this show. I've enjoyed having you on here. I hope that you'll hop back on and give us a 2026 update. You know, we'll have to call back on next year and chat about the pain.
I'm gonna send you over this one pager.
Yeah,
that shows how this cycle has been replicated 3 times just here in the U.S. in the past 50 years. And you'll be like, it's hard to not be a believer.
Mm-hmm. Yeah, no, I honestly, I've been thinking this is coming for a couple of years now. And it just, like I said, it just keeps like this, the carrot's just been dangling in front of us. But the good news is, right? And the good news is I do believe that there is a lot of patient capital right now sitting on the sidelines. I know
there's a lot of afraid capital too, though. People are afraid to invest.
Yeah.
Ready?
Well, and yeah.
Real patient capital are the people that are wanting to pounce on the opportunity. The other capital, like I said, is really scared capital. I don't know what to do. I don't want to take the chance.
Right.
I might get in at the wrong time. I might be too early.
Yeah.
So, but people are definitely pulling back. And I think that I think that also because of how fast the current administration has been moving, I think people are not sure of what's going on, what's the impact, stuff like that.
I totally agree with you. I mean, anytime there's an administration change, there's going to be some turbulence. I mean, I think that it's a pretty well understood thing. I just think that everyone maybe underestimated how quickly he said we were gonna see some of these changes happen, and
we had 4 years to plan.
Yeah.
Right.
I know. It's crazy, man. Well, DJ, before I let you go,
yes.
We have a tradition here at the Gold Mine that you, every guest, leave the audience with one final gold nugget. So go ahead and leave the audience with one final gold nugget. Take it away.
The biggest gold nugget is what I brought up before. We're going into the recession 26, 27. So be ready for it. Don't be scared of it, but look for it so that you can take advantage of it.
Love it. I'll be ready, man. And I know you will be too.
Thank you so much, Danny, for having me on the show. I know that we had some technical difficulties last time, so I appreciate your patience and we'll be in touch for sure.
Sounds great, man. No, this is awesome.